Okay, great. I think we can kick off and start off. First of all, thank you very much for joining us this morning. This is our quarterly webinar for the 10x multi-asset funds, and we're going to look ahead into Q4 of this year. Firstly, just a little bit of housekeeping before we kick off. You'll find a Q&A button. Please feel free throughout this presentation to drop any questions that you do have into using the Q&A feature. I will try to keep some time towards the end of this presentation where we can try to answer as many of the questions that you have. And if not, if you think of any questions later, please do reach out and get a hold of us, and we'll be more than happy to answer those. Just a reminder that CPD points will be available. As long as you've entered your details correctly, we'll reach out to you with the relevant certificate in due course post the webinar. And yeah, that is pretty much it. So we might as well jump into it. The structure for today is going to just very quickly look at what has been a very volatile year, a couple of key standout in terms of how we think about what's driven performance over the last 9 months. We'll dive into portfolio performance, how the 10x Your Future portfolio has done, what's worked, what hasn't worked. And then we'll spend the bulk of today's session looking at a couple of key market observations, some risks that we see are starting to brew, and we'll finish off with our current positioning and then have some time for questions. So we will kick off. I mean, it's been an incredibly volatile year. I think we saw, following the announcement of tariffs at the beginning of April, a lot of market volatility, but quite interestingly, both from your two key main asset classes being equities and bonds, both of those pretty much recovered following that brief and volatile sell-off in April, and have sort of continued in terms of their normal relationships. But there really have been two asset classes which have continued divergences since the 31st of March. And that, on the one hand, has certainly been the dollar, which has continued to weaken throughout the year. And the other, of course, has been gold, which we see continuing to tick up over 4,000. I think it was close to $4,200 this morning. So that, of course, has been an incredible tailwind for the South African market, and we'll unpack that. But as we look at things here over what has been a very volatile 9 months, it's actually been a great time to be invested in markets. You've had really strong real returns in an environment where inflation's been somewhat, certainly from a South African perspective, pretty contained. And if we look at it, that weak dollar that I was mentioning on the previous slide has actually been a big contributor in thinking about how asset classes, certainly equity asset classes, have really performed around the world. I mean, we know that in a weak dollar environment, it's pretty supportive of emerging markets, of markets outside of the US, and that's exactly what we've seen this year. So here we're looking at a number of different markets. We've rebased that to 100 at the start of the year, and we're showing these returns in rands. And actually, while in dollars we've seen strong returns to the US equity market, in rand terms, the S&P 500 is only up 5% over the first 9 months of this year. So really lagging other markets. We've seen broad emerging markets really deliver strong returns. And two of the standouts there have certainly been China and South Africa. Two markets which, if we wind back 12 months ago, were certainly some of the markets which were showing much more attractive valuations, and from that low starting point have actually delivered pretty strong returns. But even when you look at markets like developed markets ex-US, you've seen sort of almost a 10% outperformance relative to the US. So it's really been, from an equity market performance, anywhere outside the US has delivered stronger performance over the first 9 months of this year, in the context of that weaker dollar. And really, we've seen this divergent commodity prices, which has been an incredibly strong tailwind for the South African economy. I mean, from a terms of trade perspective, we can see here we pulled up two of our main commodity exports, obviously being platinum and the broader platinum group metals, as well as gold. And we can see that really over the last 12 months, those are up kind of 45 and 60%. It means we're earning a lot more dollars in for our exports. And the rand price of oil has really been pretty benign in this environment, actually softening by about 7%. And that's really helped keep a lid on inflation locally, but equally seen a lot less dollars flow out of South Africa for our imports and created quite a strong underpin for not only our terms of trade, our current account, but also feeding through into lowering some risk premium in South Africa as well. It's quite interesting. We had a look at the evolution and the exposure to gold miners over the last decade. If we cast your mind back to kind of 2014, 2015, gold miners made up about 1.5% of the all share. That was really during that period of kind of the tail end of that commodity bear market. And as at the end of September, that number's ticked up to 16%. Now, that is a materially outsized position when we look at global equity markets around the world. So when one thinks about building a South African portfolio, which might have outright exposure to gold, maybe it's something that you've held in the portfolio structurally for the last 10 years, sort of a 2.5%, 3%. Your sensitivity and your beta from a total portfolio perspective has materially improved, because we know that the miners aren't even just the metal, obviously a leverage play on that. And you can see that on the right-hand side in terms of over the last 12 months, the resource sector is up something like 99%. If you hone in on platinum shares and gold miners, you're looking closer to 200%. So it's really been a strong standout part of our market. And as South African equity investors, we've really benefited from what is quite a unique composition of our market. When you look at the more locally focused sectors, you can see financials delivered 5%, and that's a total return over the last 12 months. So really talking to some of the longer term structural headwinds we've had in South Africa, even though it's been certainly the tail end of last year, maybe slightly less so this year, an environment of much better improved sentiment. And that kind of really bifurcated underlying exposure has seen really strong returns to the all share over the last 12 months, as I mentioned, being one of the standout equity markets. So when we look just in aggregate at broader asset class returns, we can see, I think there's two observations that are quite important to make. I mentioned earlier that we've been in an environment of very soft inflation, call it roughly in at 3.5%. That sets that real return hurdle against which asset classes need to generate returns to see investors increase their wealth in real terms. And pretty much across the board, it's been a really great time to be invested in markets. Obviously, coming off a slightly lower base, we can see SA equities both over on a year-to-date basis over the last 9 months and over the last 12 months, really driving strong returns around 30%. SA property has been slightly softer. It had a really strong kick up immediately in the third quarter of 2024 following the positive elections last year. But since then has still delivered relatively pleasing returns, kind of in the region of 11 to 12%. We've seen strong returns from emerging markets as well. And kind of the one disconnect on a year-to-date basis versus the last 12 months has certainly been developed market equities. If we think about the fourth quarter of 2024, Trump was elected as president in the US. We saw really strong dollar environment. We saw US risk assets rally significantly as everyone discounted a lot of potential kind of reforms, easier business environment, potential tax reliefs, pro-business policy stance from the government. However, set against that weakening dollar from the beginning of the year, we've seen really US equities underperform on a year-to-date basis, but on a 12-month basis have still been pretty strong. And when we cast our mind to defensive assets, the weaker dollar, stronger rand environment has obviously been a bit of a headwind to global defensive assets from a South African investor's perspective. SA cash, inflation-linked bonds delivering against inflation of 3.5, still strong real returns, but it's really been nominal bonds that have been the main beneficiary as we've seen that inflation risk premium compress significantly in South Africa. So putting that all together from a portfolio perspective, here we can see on a one-year basis, 10x Your Future Fund has kind of lagged the benchmark of the peer group, so CISA multi-asset high equity. That's primarily been because of our lower allocation to US assets, which we have been running for almost 18 months, 12 to 18 months now. And that's really isolated in the fourth quarter of 2024. So as we step through the next couple of months, we'll start to see that drop out of the one-year number. But what you can see on a year-to-date basis is despite being more defensively positioned throughout the year with a high allocation to bonds and cash, and we've been in an environment where growth assets have really actually delivered pretty strong returns in the rebound since the tariff saga in the beginning of April. We've still managed to outperform the peer group on a year-to-date basis, and we've done so with materially lower risk. The main drivers for that have been our global equity positioning with a much higher allocation to emerging markets and outright exposure to China, as well as an overweight to developed markets, ex-US, really being funded by a much lower allocation to US equities. So that global equity positioning has really helped. What's detracted? Well, we have been slightly more defensively positioned, so that higher allocations to global bonds and cash, despite the attractive real yields. What's happened with the rand has obviously taken the shine off that asset class, and our higher allocation to inflation-linked bonds, locking in real +5, has been slightly softer than what we've seen from nominal bonds. So that's kind of what's worked and what's detracted over a year to date and the last 12-month basis. I think despite that, there's one observation that's important to make. You look at the 5-year numbers, and here not only looking at the 10x strategy, which has outperformed the % per annum over the last 5 years, but even just from a high equity perspective, we've seen the average high equity fund deliver returns of 13%. Inflation's been kind of 4.5%, 5%. That's meant that over the last 5 years, as South African investors into Reg 28 high equity balanced funds, you've earned something like inflation +7 to 8% per annum. Now, we know that markets are cyclical. We know that markets, typically periods of really strong returns, are typically followed by periods of slightly softer returns. From an expectation management perspective, we've gone through 5 years of what has been really stronger returns. So kind of as we look forward, one maybe potentially needs to moderate their expectation, because kind of through the fullness of time and through most cycles, on average, on rolling 3 to 5 year periods, a high equity balance fund has delivered something like inflation +5 to 6%. When you stretch the time horizon out, our strategy over the long term through multiple cycles over the last 15 years has still outperformed the peer group by more than 1.5%, kind of showing the value to the long-term approach. So that's kind of covering off and touching on really some of the drivers from performance over the last 9 to 12 months, what's been happening from a portfolio performance perspective. Going to spend sort of the next half an hour looking forward, looking at some market observations. Now, our process is really anchored very systematically, very quantitatively in terms of setting real return expectations across a range of asset classes, looking out over the next 5 to 10 years and building a portfolio today that maximizes the probability of delivering those real returns through the cycle over the longer term. We're not in the game of trying to tactically asset allocate core markets over the shorter term. But what we do is we're very aware to what markets are pricing, to certain market observations, and we run our portfolios through a range of scenarios to understand kind of some of the sensitivities based on some of the risks that we see brewing in the market. So I'm going to spend a bit of time talking to some of these market observations and some of the risks that we see on the horizon that are brewing. I think the first point, and I mean, I'm sure everyone has kind of heard and seen kind of tariffs to death. It's quite incredible, though, if one thinks about how the market has really, from a behavioral perspective, responded to what we've seen over the last 6 months. We saw these reciprocal tariffs come in at ridiculous levels. They were then walked back given the response to markets, and subsequently have actually landed still at levels that are the highest since 1930, and the markets kind of effectively shrugged that off. And we've seen this really strong rebound over the last 6 months, pretty much ignoring what's happening from a tariff perspective. So what we're showing here is not the tariff rate, but actually the dollars that have been bought in from a customs perspective. Now, a tariff is ultimately a tax. That's how one can think about that. It's revenue that the government generates for itself. Now, what we've done here is we've taken the monthly tariff receipts, and the latest date is to the end of August. And obviously, we know there's some, with the government shutdown in the US, there's some challenges in terms of getting hold of new and updated government data. So that's the latest that we've got. But we've annualized those monthly tariff receipts to get to sort of an annual number. And based at the end of August, that number was something like 354 billion, would equate to, if we received all the tariffs that we received in August, consistently throughout the year for the next 12 months. Now, when you are thinking about a tax, someone needs to pay that tax. And when it comes to tariffs, there are effectively three players that can bear that cost. One would ultimately be US consumers, and that's typically through higher prices and inflation, if corporates are able to pass on the cost of those tariffs. The other person that might pay that tax could be US corporates, effectively in terms of lower margins. If they can't pass on those higher costs to consumers, it ultimately impacts their profitability. And the third option is obviously exporters. And we don't have a good sense of exactly who's been bearing these costs up to now. I mean, I read some research over the last couple of days that was sort of saying that from a who's bearing a perspective, and take this with a pinch of salt, it was something like 10% of exporters, 50% of consumers, and 40% of corporates. Now, why that matters is because depending on who pays this is where you'll see it come up. Either, if the bulk is going to be paid on the ground in the US, it's either going to hit earnings or it's going to see an increase in CPI. Now, we haven't really felt the effect of that. And why is that? Well, in the first quarter of this year, a lot of people were concerned about tariffs, and there was a lot of front loading of imports before the tariffs hit. And you actually saw that massively skew GDP in Q1. Big imports are a big drag on GDP, and you saw this negative, really soft GDP print in Q1 of 2025 in the US. And this massively unwound in Q2 of 2025 as kind of imports got massively smashed. But the slow bleeding out of that stocking that we saw in Q1 has actually shielded businesses and consumers from the main impact of these tariffs. And these big cash receipts are only starting to come through in July and August of this year. So I don't think we're yet to quite see the full impact of this. And the market really is not discounting concerns either in terms of inflation or earnings hits to the US. I think the coming earnings season will be very informative as we start looking at Q3 earnings in the US to see if there's signs in terms of whether corporates are going to be paying this tax or whether it's going to be passed on to consumers, which I think will be very informative if we actually get hold of any data out of the US government. And we'll obviously need that shutdown to end there to start getting more clarity around the data. But I think at this point, the market's become incredibly sanguine about, and rather than it not having shown up at all, it's more a case of it hasn't shown up yet. Set against that is that we've seen, as a result of more policies, primarily around immigration in the US, we've seen a lot weaker job creation. Now, typically, when you see weakening job creation, there's normally a big uptick in unemployment rate. But the unemployment rate's actually been relatively constrained, sitting about 4.2%. You can see that pink line with the axis on the right-hand side shows you that unemployment rate has kind of ticked up, but it's pretty much in the same area as it was at the middle of 2024, and it hasn't really deteriorated, despite the fact that job growth has deteriorated quite significantly. And you can see that the light blue line shows the 3-month moving average. The dark blue bar shows the actual job gains, and we've seen a significant revision in terms of historical numbers, much lower. So where we are, because there have been a lot fewer people requiring jobs, the break-even level to keep inflation much lower has meant that just much fewer jobs needed to be created in the US. But because we've seen the softening of job growth, that's really what's led the Fed to kind of move into this sort of insurance cut environment, saying, you know what, when we talk about our dual mandate of growth and inflation, seeing what we're seeing here in the job market, we're more worried about growth, even though inflation is still quite elevated. And off the back of that, we've seen a significant increase in the rate cut expectations that have been priced into the market. So here, what we pulled out, starting at the beginning of this year, is the market's expectation of where the Fed rate will be at the end of next year, 2026. And what you can see is that from where we are today, there are nearly 5 interest rate cuts baked in between now and the end of next year. And that rate has continued to drift lower. So the market is discounting the fact that the Fed is going to continue cutting quite aggressively, given the weakening in the labor market. And ultimately, if you look at like the Fed's dot plots as well, I mean, they've become a lot more scattered as there's been more talk about really divergent views and what's happening from the politicization within the Fed. But they've actually showed their hand in terms of the fact that they're prepared to cut, despite the fact that you've got inflation, which is still relatively elevated. I mean, they target 2% through the cycle. We're sitting just under 3% in the US. I mean, there are some signs of softening inflation, whether that's through softer house prices, lower real wage growth across a number of areas. And also importantly, one can't dismiss the fact and the impact of materially lower oil prices as a driver of inflation. So there are some signs of cooling inflation, but that needs to be set against the risks of who's going to bear the tariff costs. And we're not quite sure where that sits. However, the Fed has said, you know what, we're more worried about growth and what's happening in the labor market. So we're comfortable ultimately cutting. Now, what's interesting about this cutting cycle, and one needs to bear this in mind when one thinks about different scenarios going forward, is typically the Fed cuts interest rates into an environment of tight financial conditions. This is the US Financial Conditions Index. It's basically just an index which groups together a whole number of different variables, and it's a marker of how tight or loose financial conditions are. This blue bar is kind of towards the top. Financial conditions are pretty loose, and so I've kind of marked with that pink bar where financial conditions are sitting, and in aggregate, we're actually in a very loose financial condition environment when we look back over the last 5-6 years. So the Fed's cutting into what is actually quite a bullish environment. I mean, look at what goes into this is a lot of things like volatility, credit spreads, equity market prices, valuations. And what you can see is we're in an environment of actually really quite a bullish environment. The argument people could make is that it's pretty much priced for perfection, both from a credit and an equity perspective. And you haven't really had the Fed cut in these type of environments. I mean, the best way to look at that from is here we show the US Fed funds rate and S&P 500 12-month forward earnings expectations. I'm going to pull up just this laser pointer to make the point a bit clearer. What you can see is kind of in the late 90s, you had a big hike up in earnings expectations and the Fed tightened the market. You had earnings expectations following the burst of the TMT bubble derate quite materially, and the Fed obviously cut into that environment. Similar in from 2007 here at this point where the Fed started cutting, you'd already seen earnings expectations start rolling over, and the Fed cut into that environment. Similarly, here in kind of 2018, 2019, earnings expectations were kind of flat, and you had the Fed cut rates. But what you've seen in this cutting cycle, which really started in September last year and has continued, is that you've got this disconnect of rate cuts into more and more bullish earnings expectations into the US. So what you can have here in an environment of what is effectively quite loose financial conditions, the Fed is cutting into an environment where you're having stronger earnings expectations. It could potentially be the fuel to fuel markets higher and push valuations even more extreme over the coming 3 to 6 to 9 to 12 months to kind of be that fuel that's required. When we look at kind of much longer term valuations, I mean, you've got things like the US cape ratio sitting now at about 39 times, topped out at about 44 in 2000 with the TMT bubble. But really from the starting point, what you are saying is we believe if you back equities from this point, that actually we're going to go into really uncharted territory from a valuation perspective. And we think that that's justified based on potential future earnings growth and that companies can grow into their earnings. But from these starting points, we have really struggled to see positive real returns to US equities over a 5 to 10 year time horizon. However, that risk does exist that given the looser monetary policy, potential increase in liquidity, that markets are pushed materially higher from here in sort of a blow-off top type scenario. To underpin that, well, it's really elevated margins in the US that are underpinning the strong earnings growth. I mean, here we've got S&P 500 profit margins, got the actual profit margins going back to 2016 and then forecast through to 2028. Sorry, 2006, not 2016. From 2006 all the way forecast to 2028. And really what's underpinned this US exceptionalism over the last, call it 14 years, has been expanding margins in the US. We had these really capital light tech businesses in the early 2000s that were able to generate really high return on invested capital off a relatively light asset base. And they were able to drive a lot more margin efficiencies in terms of cost line growth while not requiring to sink a lot in terms of expenses. The other contributor has obviously been the extent to which US equities have bought back significant shares through share buybacks, because many of these companies were throwing off significant loads of free cash flow, which really meant that they were continuing to buy back shares. From a capital allocation decision, one needs to think about the efficacy of share buybacks when you're sitting at something like a 39 times cape ratio. But equally, and I think this is probably more important, is when one looks at the AI capex build out, it can impact this picture over the next kind of 3 years in two main ways. The first is ultimately through return on invested capital. The chart on the left-hand side just looks at the group of hyperscalers who I think are familiar to everyone now, likes of Amazon, Google, Meta, and it looks at effectively their capital intensity. So that's effectively quarterly capex to revenue. And what you can see is during that early kind of 2014, 2015 period where these one platform, one decision businesses really rewrote a lot of economics in the US, they had effectively capital intensity measured by capex to revenue of under 8%. That's steadily grown over the last couple of years. And really since the advent of ChatGPT has actually exploded. It's gone from, let's call it 13% to this year over 25%. And actually, if the hyperscalers were a sector, they would only be behind utilities as the most capital intensive sector on the S&P 500. And that's just what they've spent this year. So the chart on the right-hand side shows actual and forecast capex spend across those hyperscalers. The darker blue bars are the actual. And so what you can see in 24 and 23, that number was about 400 360 billion. If we take kind of the last 2 years, let's take the full expected 2025 number of 380, add that to last year's 227. Well, you're getting something like 600 billion of capex over the last 2 years. And that's just set to continue to grow out in 26 and 27. So when we think about what's underpinning the strong earnings expectations that are required to support the large and elevated equity valuations that are currently embedded in US equity markets, well, the two risks to that is, one, not only how are these hyperscalers going to monetize the significant capex spend, but two, what's it also going to do to the free cash flow that they're throwing off? Because what we're seeing this year is that free cash flows to the likes of businesses like Meta are effectively evaporating. They all being plowed back into this capital expenditure. And so what it's going to mean is there's potentially going to be less cash on the table to support share buybacks as well, which has been the second main contributor in terms of the expanded margin. So there certainly are a number of observations, a number of risks to the path that the market is currently discounting. And when we say the market's priced for perfection, well, ultimately, when the market is priced to see that these hyperscalers are going to continue actually expanding their margin, not contracting their margin, despite the fact that they now need to start depreciating all this capex spend over the next couple of years, and actually generating sufficient revenue to create the return on invested capital, which ultimately supports those higher margins. So this is the base case that is currently being discounted by the market. It's quite difficult to understand a bull case that sits above this base case. I mean, when you kind of go through the scenarios of typically sitting a base case, a bull case, and a bear case, what is currently priced into markets ultimately is effectively the bull case. And that means there's kind of a base case where margins potentially don't continue to increase as these businesses need to start increasing their depreciation, potentially less cash flow for buybacks. And then there's a bear case where ultimately, you know what, well, we have a dot-com type of environment where the market realizes these businesses stop and pull back on their capex spend, and that effectively deflates what is really a capital cycle that kind of mirrors what we saw in 2000. So here we're just effectively showing capital spending associated to tech, data centers, power and communication structures as a percentage of GDP in the US. And we can see that it's hitting similar levels that we saw in 2000. So there's certainly markers that the spend as a percentage of the total economy is hitting levels seen in 2000. So the question really now becomes, how do they monetize the spend? What that means from an investor perspective, allocating to something like the broad S&P 500, is that there is significantly elevated concentration risk through two lenses. The chart on the left-hand side looks at the technology sector as a market cap and as a percentage of earnings in the S&P 500. And it goes back all the way to 1995. And I mean, the interesting thing is that you've seen that actually the market cap of tech shares has continually ticked higher over the last 5 years, making something like 35% of the S&P 500, whereas its share of total earnings has actually been pretty flat at 20%. So there's a lot more value associated to this part of the market without an equivalent increase in its share of earnings of the S&P 500. Similar disconnect to what we saw kind of in 2000s. So that's the one thing from a sectoral perspective. But the other thing to think about from what is ultimately an idiosyncratic perspective is that the largest 10 shares on the S&P in the S&P 500 make up something like 42% today. Much higher than what we saw in .com, much higher than what we saw with, around the unwind of the Nifty 50. And so when we sit here today and from our perspective, we typically make asset allocation decisions, and then we implement that exposure using a range of different indices. Why is that? Well, because we typically want to earn that broad-based asset class risk premium, and we don't want what happens to any one share to impact our outcome over the longer term. The reality is investing in something like the S&P 500 today embeds significant idiosyncratic risk in your exposure. And that's actually one of the main reasons why one would typically want to use an index, because it diversifies that single stock risk. But perversely, that's actually what you get when you typically investing in a market cap index exposure today. So from our perspective, we certainly are focusing in terms of how we can diversify that single stock risk, not be so concentrated in this elevated part of the market, because ultimately for us, we're looking through over the next 5 years, not the next 3 months. We want to generate real returns for our clients through the fullness of the cycle. It's quite interesting. I mean, certainly there's been a lot of noise in the media over the last 3 to 6 months about a lot of the circular financing and interconnectedness that's happening in the AI space. It's quite interesting in that there are a lot of similarities between not only the last .com bubble, but also the bubble that we saw in Japan in the 80s, both in terms of circular vendor financing as well as cross-shareholding. I mean, over the last couple of months, we've seen NVIDIA announce a deal where $100 billion deal with OpenAI. OpenAI has announced a $300 billion deal with Oracle, and OpenAI is going to further hold shares in AMD, but also invest billions in terms of AMD chips. And you really have the circular web of cross holdings, revenue recycling, and many of these deals, the actual details around them have not even been specifically released. I mean, just take NVIDIA, for instance. NVIDIA said it's going to invest $100 billion in OpenAI. It has $57 billion on its balance sheet. So it's going to take the $57 billion of cash that it has on its balance sheet. It's going to take that, and it's going to take $43 billion of future profits and really invest that in a single customer, who's then going to take that $100 billion, okay, and use that to buy NVIDIA chips. And NVIDIA is going to recognize that profit immediately today and apply something like a 50 times earnings multiple to that revenue stream. And you can see this embedded circular nature is working. You're seeing companies jump 20% on the day, from a market cap perspective, on the day that a deal like this has been announced. And it really just throws back signs and echoes to previous bubbles, and does create a lot of risk in terms of actually the interconnectedness of these private market businesses and public market businesses. And it's something that we are looking at, something that we're monitoring at, and something that we are very cautious in terms of as we look out over the next 2 to 3 years, in terms of how this web of interconnectedness will actually be monetized and turned into actually cash profits at the end of the day. And that's the big risk and the big question. Now, I certainly take the argument that's been put forward a number of times in terms of the fact that, you know what, you can't really compare the valuations of the S&P 500 to what we saw in the 2000s, because those were businesses that really weren't making any profits, and kind of these hyperscalers are massive businesses making significant profits today. The comparison isn't fair. And while I hear that point, the extreme level of valuation still creates a significant headwind for public markets. But I think there is some validity to that point, because where the extreme valuations sit today is ultimately in private markets. In 2000, it was the dot-com era. Every business listed sometimes before they even had a proper business plan, they just put .com in their name, they went to list, and they raised significant assets in the equity capital markets. But this trend to private market investing that we've seen over the last 10 years has significantly increased, and businesses are staying private longer and longer. They're being financed by these massive allocations from private equity We've seen private credit as an asset class grow materially. And actually the crazy valuations from a revenue multiple perspective are actually sitting in the private market space, not in the public market space. But with many of these interconnected deals between NVIDIA, OpenAI, Oracle, AMD, is creating more interconnectedness between the private markets and the public markets. I mean, you're seeing something like OpenAI is on something like 116 times revenue multiple, 500 billion the market valuation. I mean, it's not a small business, it's not a small valuation. Interestingly, over the last 3 to 4 months, you've just seen insiders. I think the last raise that valued OpenAI at 500 billion a couple of weeks ago saw insiders sell significant stakes. So if you look at what those who hold the shares are doing, they're selling. Look at what kind of insiders in NVIDIA are doing, they're selling. And that's often quite an important market to take aware of. So significant valuation sitting potentially more so in the private markets. But what's quite interesting is that from a regulatory perspective over the last couple of years, and really following the GFC, your big Wall Street and mainstream banks have been significantly de-risked. You've seen a lot of lending move off balance sheet and really into private credit space. And private credit as an asset class has massively increased. I mean, and so kind of as it goes is that, well, you know what, banks are a lot more protected. They're a lot less exposed to risky lending. However, instead of lending directly to businesses, what banks have been doing is they've been significantly increasing their exposure and lending actually to sponsor back private credit and private equity businesses. And those are really defined as non-depository financial institutions. So what we're looking at here from about a 4% exposure of US banks to private credit and private equity has actually increased materially to about 13%. And you can see a big tick up actually at the beginning of this year, where there was a change in regulatory disclosure. A lot of those loans were classified as C&I loans and had to be reclassified. So there is actually a growing interconnectedness here between kind of the banking system and private credit as an asset class. Banks typically have much tighter lending standards. Private credit is typically a lot more opaque. And because there's been this big wall of money investing in private credit, needing to find a home, the terms at which this private credit has been invested and granting loans at have typically been materially inferior to what you've seen in the public markets. But despite that, that interconnectivity still does exist. And what's quite interesting is we've seen over the last couple of months that there's actually been quite a couple of signs and cracks starting to show in credit markets, and more specifically private credit markets. There's been the Tricolor bankruptcy, also the First Brands bankruptcy. And what we're showing on the left-hand side, there is a way to try get a view in terms of if private credit, which typically only gets marked on a quarterly basis, was marked to market daily, what would the asset class be telling us about the health of that asset class? And thankfully, there is one marker. They're called BDCs, business development companies. They're basically listed entities that provide financing for private credit transactions. And what you can see is that actually there's been quite a lot of cracks showing in those BDCs. That's that dark blue line that we've seen. And if we roll this forward actually over the last 2 weeks, we're kind of sitting quite close to where we were at the April low. So it's continuing. However, public credit markets, including both high yield credit and leveraged loans, are pretty sanguine and kind of saying there's not really a problem here. And they're doing that at a time when credit spreads, again, are the tightest that they've been going back to 1998. So not only from an equity market perspective, but from a credit market perspective, one can make the point that markets are priced for perfection. Valuations are incredibly tight, and now is not the time to be taking risk as you stretch your time horizon out and think about generating real returns. I'm going to kind of try to step through this so we can take some questions quite quickly. The other thing that has been quite a standout this year has been the concern in the bond markets, where we've seen long end yields increase significantly. Yield curves have steepened dramatically. 30-year government bond yields, whether that's in Japan, Germany, US, have continued to tick up throughout the year as investors are saying, you know what, governments have these significant debt loads. That was one thing when interest rates were zero, but now you've got elevated interest rates, and how are they going to sustainably one, not only afford the current interest payment, but two, from a fiscal perspective, across the world, we're seeing increased fiscal spending, which only means that that deficit gets greater and only potentially contributes to further debt burden. Why that's important is because obviously as multi-asset investors, we live in a cross-asset world. As government bond yields continue to tick up, well, government bonds start becoming more and more attractive relative to equities, the higher the starting yield is on government bonds. And as we've seen this tick up in the long end, obviously in the face, and as a result of investors asking questions around debt sustainability, it obviously means that relative to equities, bonds are more attractive and equities are conversely less attractive. And one way to view that is through, here we've got an excess cape yield. You can think about it effectively as an equity risk premium. It looks at the cape yield and removes 10-year real yields in each of these countries. And what you can see is effectively that excess cape yield is the smallest in the US, where there's still significantly more fat ultimately baked into UK, Japan, Europe, developed markets outside of the US. So those higher rates are becoming a bigger and a bigger problem for US equities relative to equities outside of the US. That goes into a lot of our positioning, which we'll touch on later in terms of starting to become more interested from a valuation perspective in longer duration US government bonds, and more attracted to developed markets outside of the US from an equity perspective. Quickly, just to finish off from a South African perspective, we've obviously seen a strong rally in the SA equity market thanks to the gold prices and platinum prices and what that's meant for the leveraged miners. But equally, we've had real rates in South Africa hang around this 5% level, which are some of the highest real yields we've seen in South Africa going back to the early 2000s. Now, what does that mean? Well, SA equities have got slightly more expensive given the run-up that we've seen over the last year, but they're still in their own right, somewhat fairly valued. But relative to bonds, relative to those high real yields, that excess risk premium is starting to get quite compressed from this point. In fact, so much so that it's the tightest that it's been going back to 2003, tighter than we saw in 2007. Ultimately, what that means is you can still continue to lock in real 5 from investing in inflation-linked bonds from this starting point, real 5 to 6 from nominal bonds as well from this starting point, which again, tying back to the outcome, is a great and low-risk way to deliver real 5 for investors without taking as much risk. And I'm going to end off on this slide before we jump into portfolio positioning. We've spoken a lot around some narratives, some risks that we're keeping an eye on private credit in terms of how these AI hyperscalers are going to monetize their CapEx spend. No one knows the answer to that. But when you think about scenarios looking forward, and when you think about the drivers of returns, it's quite simple. It boils down to a math of 3 components. Any historical equity market return or forward-looking equity market return is made up of 3 components. It's made up of a dividend yield, it's made up of earnings growth, and it's made up of a change in valuation. And so what we've got here is obviously I mentioned kind of sitting at 38, 39 times CAPE ratio in the US. It's really at those elevated levels that we haven't seen in a long period of time. But the chart on the right-hand side gives you a little bit of a scenario analysis and a feel of the different combinations of the drivers. Let's say, and we've never seen this, okay? But let's say the CAPE ratio stays at 35 times for the next 10 years. Got a dividend yield somewhere in the region of about 1.2. And let's say you have real earnings growth above inflation of even something as attractive as 4, okay? In that environment, you're only getting a real return to US equities of 4%. It's not the 10% real return from US equities that we've seen over the last 5 to 10 years. So first, in that very unlikely environment where you have elevations stay so high, you're really doing quite a lot less than what you've done historically. But equally, if you say kind of we see increased depreciation, we see less buybacks because these tech hyperscalers aren't able to monetize their spend. Let's say we're kind of roughly in line with where long-term real earnings growth has been going back over the long term of about 2. Let's say we go back to a CAPE ratio of only 27 times, which has been the average over the last 25 years. Well, then that combination gives you negative real returns to US equities over the next 10 years. That is not even kind of declining to something like what we saw at the lows in GFC or at the lows in 2002 of around 20. There, the range gets a lot less, a lot lower down. But the other lens to look at this through is that all the areas shaded in this chart that have light blue lines indicate real returns that would be below that of the 10-year real yield at 1.8%. And through that lens, really, this is not the environment to be taking significant risk when you can lock in real returns from defensive asset classes like bonds, which for the first time in a number of years are actually paying relatively attractive real returns from the starting point. So just to wrap up here, I mean, a couple of those observations, we've seen weakening jobs markets, increasing interest rate cut expectations. That could create fuel for a blow-off top in US equity markets here. However, we've yet to really see who's going to pay the cost to those tariffs, whether that's going to feed through into EPS or into inflation. Many questions continue to increase and get raised around AI capex, which is increasingly driven by vendor financing, their cross shareholdings, and increasing use of debt rather than free cash flow to fund that, which creates more fragility. We're starting to see some stress signs in the less regulated private markets, which are still connected to public markets through a number of different channels. But more importantly, at this point, valuations have pushed on much higher than where they started the year. We were concerned at the start of the year that elevated valuations in the US would be a headwind to returns. The US has delivered slightly softer returns than global markets ex the US, but we're now at even more elevated valuations. So that same standing point exists, and especially from a cross-asset perspective when you look at that relative to bonds. Encapsulating all of this into our broad capital market assumptions, you can see not much has really changed from what we showed last quarter. Really, the big standouts are from defensive asset classes, things like cash and bonds in South Africa delivering or set to deliver much higher real returns than what they have over the longer term in South Africa. Whereas equities really across the board are looking much softer from these elevated starting valuations. And from a portfolio perspective, that means we're overweight defensive assets, we're underweight growth assets. From a growth asset perspective, we're slightly overweight SA equities, emerging markets, and China, and we have a much lower allocation to developed market equities, and that's primarily the US. And within our US equity component, we're diversifying away from that concentrated mega cap tech shares that are also exceptionally expensive. From a defensive asset class perspective, we remain overweight inflation-linked bonds, given the fact that they can lock in inflation +5 with relatively low risk. And we've started increasing duration in our global bond portfolio as yields continue to tick up through the quarter. Importantly, though, from a currency perspective, we maintain lower allocation to currencies like the US dollar with a higher allocation to things like the yen and the euro. So that's really where we sit. We remain defensively positioned. Despite being defensively positioned, we've managed to generate really fantastic real returns over the last 12 months. Now is not the time to be reaching for risk to eke out those additional returns. It's probably more prudent to invest where you can generate real returns more reliably over the coming not only 6 months, but more importantly, over the coming 3, 5 to 10 years. And ensure that your portfolio is well diversified and not overly exposed to any one risk factor, whether that's gold from an SA equity perspective or US tech from a US equity or even MSCI world type allocation. So I see we've got about 5 minutes left. Let me see if there are any questions. Please do post some questions. If you do have any, be more than happy to pick those up. There was one question here, which was posted a little bit earlier. You mentioned that we should temper our expectations of returns from high equity. How would you guide this tempering? If you have return plus minus 8% real, does that mean that we should expect less than 5% real going forward? I would say that that is a fair assumption to make. When we talk about long-term averages, averages are obviously kind of that midpoint, which are made up of periods of above and below that average. So if we've had kind of real 8 over the last 5 years, well, real 2 over the next 5 years would get us to real 5 over this 10-year period. So I think that is a fair assumption to make. Importantly, the shape of one's portfolio will be important in terms of understanding where you can source real returns from. I see there's another question asking whether we can have copies of the presentation. Yeah, we're more than happy to share that. Please reach out to the team and they will send a copy across. I see another question asking here, US market is making new all-time highs. What's happening to GLODIV? It's not performing at all. For those who aren't aware, GLODIV is a ETF that we offer clients. It's listed on the JSE. It's the Global 10X Global Dividend Aristocrats ETF. It typically invests in businesses that have, over long-term periods of time, continued to grow the dividends that they pay out. Now, it's quite interesting and really quite a relevant time to talk about this, because what are we talking about? We're talking about the parts of the market that have been driving the market are seeing their free cash flow effectively evaporate. Those parts of the market that are typically slower, that typically have much higher earnings visibility, have been completely shunned by the market. And you can see that, whether that is through, from a risk factor lens, things like quality, high earnings visibility, high and consistent, not really high dividend yield, but consistent dividend yields. And it's probably encapsulated more broadly in something like consumer staples, have been completely shunned by this market in a go-go era where everyone wants tech and AI. The difference is the earnings visibility between something like consumer staples is much higher. Their ROEs are much lower. Their EPS growth is much lower, but they deliver it with a much higher level of certainty. Whereas these high-flying tech businesses that have been driving the market up until this point have much higher uncertainty in terms of earnings looking out over the next 2, 3, 4 years. How are they going to monetize this CapEx? And so if you see the high-flying parts of the market starting to disappoint from an earnings perspective, typically what you see is then that the market rotates to these higher earnings visibility parts of the market. And that's what we saw following 2008. Interestingly, the ratio of consumer staples to broader S&P 500 is at its lowest point going back all the way through to 1999, which one could say is somewhat ominous. So there's certainly hated parts of the market, and there's certainly loved parts of the market. The big key question over the next 1 to 2 years is what's going to happen in terms of monetizing that CapEx spend. There's another question here, which I think is important. I'm cognizant that it's 12 o'clock, but I'll just wrap up to just finish this point because it's quite key from a portfolio positioning. You mentioned that inflation linkers were a detractor to the portfolio where government bonds provide better yields. Why then are you still overweight ILBs relative to government bonds? That's a great point. I think what one needs to go back 12 months ago, right? Where were we? We were in an environment where there was a significant inflation risk premium embedded in nominal bond yields. One, because it was kind of still uncertainty from sort of pre-election that was being worked out. But what we've seen is thanks to much lower oil prices, inflation come in below 3%, below the target. And that led, obviously, the Reserve Bank governor to jump up and say, okay, we actually need to move our inflation target away from 3 to 6% directly to 3%. Now, when one looks at break-even inflation, Well, that has really seen the collapse in nominal bond yields from 12.5 to kind of 9.5 over the last 12 months, and supported the strong historical return to nominal bonds, whereas the real yield on inflation linkers were 5% this time last year, and they're still 5% now. There's been no compression or increase in yield. And what's happened? Actual inflation has come in much lower, much lower, much lower, much lower. So the inflation carry in linkers through the rearview mirror has obviously been a lot softer. That describes the last 12 months. But from this starting point looking forward, inflation-linked bonds still continue to offer real 5, which is very attractive. But that break-even inflation is massively compressed because current inflation is low. It tells you nothing about future risks to inflation. And so when we look at where risks are being priced, currently we don't think that investors are really materially being offered significant inflation risk premium for investing in nominal bonds at this point in time. And there's a lot of interconnectedness between nominal bonds, SA equities, and the Rand, whereas we think those linkers will provide real returns with a higher level of certainty and better diversification in the portfolio. Unfortunately, that's everything that we've got time for today. Thank you very much for joining. Thank you very much for the questions and the engagement. As mentioned earlier, we will be having CPD points. Those certificates will be available in due course. And please reach out if you do have any more questions, or if you want to get a hold of a copy of the presentation, we'll circulate that to you post the meeting. Thank you very much, and good luck for the fourth quarter of 2025. We'll chat again in the new year. Cheers. Bye.